All right, if you're thinking about how to invest for your child's future, you've probably seen these special children's funds. So, in this explainer, we're going to unpack one of them, the Baroda BNP Paribas Children's Fund. Let's see what it's all about. As a parent, thinking about your child's future, their education, maybe their wedding, it's a massive long-term goal, right? And naturally, you start looking for the right tools to get there. That's where specialized investments often come into the picture. So, first things first, what exactly is this fund? And, more importantly, who is it really for? Let's get into its core purpose. Okay, so at its heart, this is an open-ended fund. It's specifically designed for investing in a child's name. And that's a key point. The child, the beneficiary, has to be under 18 when you start. This fund is pretty much built from the ground up with that one single goal in mind. And its main job? Well, it's all about long-term growth. I mean, that makes perfect sense, right? Goals like college are usually years, maybe even a decade or more down the road. This gives the money a really long runway to hopefully grow and compound over time. All right, so that's the what, but what about the how? How does this fund plan to get that long-term growth? Let's pop the hood and take a look at its investment engine. So you can see right away, this fund is all in on equities. We're talking 80 to 100% of its money in stocks and related instruments. The rest, a much smaller slice, can go into debt or things like REITs and InvITs. Now, this is a pretty aggressive, equity-heavy strategy. The whole idea is to aim for high growth potential, but, and this is super important, that also means it comes with a higher level of risk. No two ways about it. Okay, strategy is one part of the story, but what do the numbers say? Let's dig into the fund's performance and, equally important, what it's going to cost you. Now, the first thing you'll notice here is that this fund is really new. It only launched at the end of 2024, so we don't have those usual 1, 3, or 5-year returns to look at. All we have right now is the performance since it started, since inception. Okay, let's talk costs, and this is a big one. The expense ratio for the regular plan is 2.34%. Think of this as the annual fee you pay to the fund house. And a big chunk of that fee, in a regular plan, goes towards paying commissions to the distributor or agent who sold you the fund. Now hold on, take a look at this. The direct plan's expense ratio is just 0.38%. That is a huge difference. So why the massive gap? It's actually pretty simple. The direct plan cuts out the middleman. There are no commissions to pay, and all those savings go straight back to you, the investor. And listen, over a long period, say 15 or 20 years for a child's goal, that difference is an absolute game changer. It can literally add up to a huge amount of extra money for your child, all thanks to lower costs. And one last cost to keep in mind, the exit load. It's 1%. Basically, if you pull your money out within the first year, you'll pay this fee. It's really just there to encourage you to stay invested for the long run. Now, we've talked about the potential for high growth. But with great power comes great responsibility. And in investing, that means risk. We absolutely have to talk about the warning label on this fund. And here it is, plain and simple. The official riskometer labels this fund as very high risk. And honestly, that's not a surprise at all. When you're putting at least 80% of your money into the stock market, which goes up and down, that's the kind of risk you're signing up for. Your capital is at risk. Okay, here's another really crucial point, the lock-in period. And you need to think of this as a feature, not a bug. It's there for a very specific reason, to make sure you stay disciplined and invested for the long haul. So here's how it works. Your money is locked in for either 5 years or until your child turns 18, whichever comes first. This means once you're in, you're in. It forces you to write out the market's ups and downs, which, let's be honest, is often exactly what's needed to build wealth over time. It stops you from panic selling. Okay, let's wrap this up. I want to quickly summarize the most important things to remember about this fund. So here's the bottom line. This is a very specific kind of tool. It's heavily into equities for growth. It's officially rated as very high risk. It has a mandatory lock-in to keep you invested. And it's really only built for one thing, helping you invest for a child's long-term financial goals. And that really brings us to the big question you have to ask yourself. Is this kind of high-risk, long-term, locked-in investment the right move for your child's portfolio? The answer, of course, is different for everyone. It all comes down to your own financial situation and really how comfortable you are with this level of risk. And of course, please remember, this is just to give you information. It's not financial advice. All mutual fund investments have market risks, so you've got to read all the scheme documents very carefully. And, it's always a good idea to chat with a financial advisor to see if a fund like this